Hey, welcome back. It's Nolan Mathias from Mortgage 360, and today we're discussing cashback mortgages and whether or not they are a good idea. We're also going to talk about how the bank uses them to make more money off of you and the potential risks associated with taking a cashback mortgage. But before we get into it, do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you see this video. And don't forget about our race to 10,000 subscribers, where one lucky subscriber is going to win their monthly rent or mortgage payment for a month just for subscribing to this channel. I have to thank the 3,000 new subscribers in the last 28 days, as well as the 6,000 total subscribers that have been with me since the start of this journey. Yes, that's right, we're now over 6,000 subscribers, and that 10,000 subscriber mark is within reach. We had our biggest subscriber day yesterday of 300 people, so thank you to the 300 new people here, and I hope you enjoyed this video. The definitive guide on how to manage your credit: product, penalty, price, in that order. It's never been more important to get your mortgage right. Okay, so let's get into it. Let's discuss cashback mortgages and whether or not they're a good idea for you. Because here's the reality of anything to do with a bank or a lender, is if it seems too good to be true, it probably is. And cashback mortgages, just like super low interest rates, are no different. If it seems like it's a really, really good deal and that they're giving you free money, chances are they aren't. So let's talk about it. Let's discuss cashback mortgages, because as of right now, this is all the rage in the mortgage industry. If you search for cashback mortgages, you will find all sorts of ads just clogging up the Google. You'll see cashback offers from CIBC, from Royal Bank, from BMO, from pretty much every major bank in Canada. And the question is, why all of a sudden are these such a popular thing? Because, 4 or 5 years ago, they were getting pretty popular. Back in the early 2000s, they were really popular. People could use a 5% cashback mortgage in order to borrow the money for a down payment. They paid a substantially higher interest rate in order to do so, but allowed somebody to buy a house with zero down. Remember those times back in the early 2000s when everyone thought housing prices couldn't go any higher and you were buying houses for $300,000 or $400,000? Yeah, back then you could buy with a zero down payment. Well, here's the thing about cashback mortgages, is they never really went away, but there were times where people got smarter about whether or not they should take a cashback mortgage, because what people started to understand was that just like everything else in life, you get what you pay for. And in this case, when you get cash back, you always end up paying for it. And there's two ways you essentially end up paying for it. One is through paying a higher interest rate, and two is by having to pay it back if you break your mortgage early. Yes, that's right. In almost every case, if you take a cashback mortgage from a lender, you have to pay it back if you break your mortgage early. And some lenders are better than others on this front. So I'll use BMO as an example. My mom was a senior lending manager there for 47 years. My dad helped them when they started their broker service division. And the BMO is great with their cashback because, yes, they'll give you $3,000 cash back right now. And yes, you will have to pay the cashback back if you pay off your mortgage early. However, they only make you pay back a proportional amount to what's left on your mortgage. So if you have 1 year left, you have to pay 1/5 of the cashback back. If you have 2 years left, you have to pay 2/5 of it back, and so on and so forth. And this is great because they're only basically charging you for the amount of time that you have remaining if you decide to break your mortgage early. Now, I'm going to tell you why breaking your mortgage early and the cashback could be a problem at the end of this video. It has to do with locking in rates and so on and so forth, but just stick with me for now, because there are some other lenders out there who don't allow you to pay back the cashback in proportion. They make you pay back the entirety of the cashback when you go to break your mortgage. So I'll give you an example. We got a recent mortgage payout statement from a big bank. I'm not going to say who they are, because quite honestly, what I want you to do is I want you to start calling mortgage brokers and start asking around, and I want you to find out this information for yourself so that you're getting a second opinion, not just talking to your bank or assuming that because I mentioned who the bank was, that you're safe. But what happened with this particular bank is they sent a payout statement, and we had requested the payout statement for a day prior to renewal. The reason why was because the mortgage renewed on a Saturday, so we wanted to close the mortgage on a Friday, because guess what? The lawyers and the title insurance companies aren't open on Saturdays, and neither are the lenders. So we asked for that payout statement a day early. Payout statement comes in, and on it says the client has to pay back the full $3,000 because they're paying out the mortgage a day early. Absolutely ridiculous. So we switch it to Monday, and guess what? All of a sudden, the repayment of the cashback is entirely gone. So this particular lender, this particular big bank, and it's one of the big five, basically will give people cashbacks. They promote it, and they promote it heavily. And they hope that at some point, if a client decides that they want to pay out their mortgage early, they're going to be faced with the proposition of having to pay that cashback back. And as a result, they're going to decide to stick with that bank. Now, where this becomes problematic is one where you have to do a refinance, or you want to switch lenders, or you want to lock in your mortgage rate, because 60% of Canadians will pay out their mortgage early. And what that means is if you're one of the people who got the cash back, and you're also one of the people who has to pay out their mortgage in the first 5 years, and for whatever reason, whether it's to refinance, whether it's because you need money to pay medical bills, whatever it is, if you're one of those people, you're going to end up being stuck with that bill for that cash back. So what you have to understand is that they didn't give you the money. It wasn't an incentive to come to us, hey, we'll give you a bunch of money if you come and join us. What it was a tool that they use to basically lock you into the mortgage long term. Because when faced with that bill, most people will stick with the existing lender that they're with. It's a surprise that comes down the road. You don't know what's coming, and then when faced with it, you're probably not going to leave the bank that is making you pay back that cash back until the end of the term. So it becomes a negotiating piece for them. Now, here's where the big problem is for most clients right now, we're recommending variable rates, primarily because you pay less for them at the beginning, and you pay less for them at the end on a penalty. They provide more flexibility, more freedom. Well, what happens if you want to lock in your variable rate 2 or 3 years down the road, and you go to the lender, you go to the bank, and you say, hey, I want to lock in, and they say, sure, here's the rate we're going to offer you. And it's nowhere close to competitive. It's not even like you can get a % lower at another lender, but they're offering you a lock-in rate that's considerably higher and saying, here, negotiate. And they say at the same time, by the way, you've got this cash back that you need to pay if you decide to leave. So your negotiating ploy becomes, I'm going to leave, I'm going to go to a different lender if you won't give me a better rate for lock-in than what you're offering me. And then all of a sudden they're saying, well, fine, you can go, but you got to pay back this cash back. And what ends up happening is you've lost your negotiating power, and as a result of losing your negotiating power, you have to either decide to pay back the cash back and go, see you later, I'm not dealing with you anymore, or you stick around, maybe you take the higher lock-in rate, or maybe you continue on with your variable rate. But basically, and I hope what you're seeing in this whole scenario is that the cash back, it seems like it's free at the beginning, but really what it is it's a set of handcuffs that makes it harder for you to leave down the road. And we've talked about how collateral mortgages are used for that purpose. And we've talked about the fact that when you want to move out and want to move to a different lender and you've got a collateral mortgage, you have to pay legal fees, and that keeps people from moving. That, in my opinion, is a lot of the reason why TD back 5 or 6 years ago decided that they were going to do all their mortgages in collateral mortgages. Well, imagine what would happen if on top of that you had a cashback that you had to repay as well. So don't get fooled by the cashback. Don't go and assume that it is free money, because it's not. You're always paying for it with the bank. And understand that there are some scenarios where a cashback makes sense. They're typically when you need it to pay off high interest debt, or when you need it for closing costs. But outside of that, it typically doesn't make a ton of sense to take a cashback mortgage, because like everything else in life, you end up paying for it in some way, shape, or form. So if you found this video on cashbacks useful, do me that favor, hit that subscribe button, hit that notification bell. Please hit that like button so more people like you can see this video. Don't forget about our race to 10,000 subscribers, and we'll see you on the very next one. Cheers.